Is silver's bull market over, or is this just a massive shakeout? After a breathtaking run from 122 down to 72 and a bounce back to 85, a lot of people are scratching their heads. What just happened? And more importantly, what's next? Today, we're diving deep into the silver market's wild ride. We'll unpack the three key factors that triggered this volatility. First, the unprecedented split between Eastern and Western silver prices. Second, the massive shift of physical silver from Western vaults to Asia. And third, the game-changing U.S. Critical Minerals Ministerial meeting. We'll connect these dots to show you why this isn't the end of the silver story. In fact, it might just be the most exciting chapter yet. Stick around, because what I'm about to share could completely change how you see the future of silver. And let's start with the price action. The drop was sharp, brutal, and it scared a lot of people out of the market. From a high of 122, we saw a waterfall decline all the way to 72. This wasn't a slow bleed, it was a liquidation event. Then, just as quickly, the price rebounded to 85. This kind of volatility isn't random noise. It's a signal. It signals a massive battle is being waged behind the scenes. To understand this battle, we need to look beyond the charts. The first piece of the puzzle is the price divergence between the East and West. For years, London and New York set the global silver price. But recently, something has changed. The Shanghai Futures Exchange has become a dominant force. We're seeing situations where prices in Shanghai are significantly higher than in the West. This isn't just a small arbitrage opportunity, it's a fundamental shift in market power. The East is no longer just a price taker, it's becoming a price maker. Why is this happening? It brings us to our second point, the physical movement of silver. For the past couple of years, there has been a historic exodus of silver from Western vaults. We're talking about hundreds of millions of ounces. Where is it all going? Primarily to Asia, with China and India leading the charge. Think about what this means. Western institutional players, the so-called paper hands, are selling. They're selling their paper contracts, their ETFs, their claims on silver. But Eastern buyers, the diamond hands, Chinoptic, are not buying paper. They are demanding physical delivery of the metal. They are draining the COMEX and LBMA vaults at an unprecedented rate. This creates a huge disconnect. The paper price in the West can be pushed down by selling futures contracts. But the physical price in the East is being driven up by relentless demand. The recent crash was a classic example of this dynamic. Western funds, likely facing margin calls or just taking profits, dumped their paper positions. This tanked the price on Western exchanges. But who was on the other side of that trade? Who was buying when everyone else was selling? The evidence points to large Eastern buyers, both sovereign and private. They used the price drop as a golden opportunity to acquire even more physical metal at a discount. This isn't just speculation. The data on vault outflows confirms it. The physical metal continues to flow from west to east. Now, let's talk about the third and perhaps most crucial factor, the U.S. Critical Minerals Ministerial meeting. This wasn't just another bureaucratic get-together. For the first time, the U.S. and its key allies officially declared silver a critical and strategic mineral. This is a seismic shift in official policy. For decades, governments have been selling off their silver stockpiles. They treated it as just another industrial metal. Now they are waking up to a reality that many of us in this space have known for years. Silver is indispensable for the future. You cannot have a green energy transition without silver. Solar panels, electric vehicles, 5G technology, they all require massive amounts of silver. You cannot have a modern military without silver. Precision-guided munitions, jet engines, and advanced electronics all depend on it. By declaring silver strategic, the U.S. government is sending a clear signal. They recognize that securing a stable supply of silver is a matter of national security. This has profound implications for the market. It means governments will now be competing with industrial users and investors for a finite supply. And that supply is already in a structural deficit. For the last few years, the world has been consuming more silver than it mines. We've been filling that gap by drawing down above-ground inventories. But those inventories, particularly the ones available for delivery in the West, are dwindling fast. So let's put it all together. We have record physical demand from the East draining Western vaults. We have governments waking up and classifying silver as a strategic asset they need to secure. And we have a persistent supply deficit that's getting worse, not better. In this context, the recent price smash from 122 to 72 looks less like the end of a bull market, and more like a calculated shakeout. It was a move designed to flush out weak hands, to scare retail investors into selling their positions, and to allow powerful, long-term players to accumulate physical metal at artificially low prices. We've seen this movie before. Think back to the gold market in the mid-1970s. After an initial run-up, gold experienced a brutal 50% correction. Commentators at the time declared the gold bull market dead. They said it was a bubble that had popped. But what happened next? From that low, gold embarked on a historic run, soaring over 700% in the following years. The 1970s correction was a shakeout, not the end of the trend. It was the market's way of building a stronger foundation for the next major leg up. I believe we are seeing a similar pattern in silver today. The fundamental case for silver has never been stronger. The supply and demand dynamics are incredibly bullish. The geopolitical factors are now aligning to favor silver. The industrial demand is non-negotiable for the world's future technologies. The investment demand is awakening, especially in the East. And now we have government demand re-entering the picture in a big way. So what does this mean for you as an investor? It means that volatility is the price of admission. There will be scary price drops. There will be shakeouts. The powerful interests that benefit from a low paper price will not give up easily. They will use every trick in the book to suppress the price and shake you out of your position. But their game is getting harder to play. The physical market is overwhelming the paper market. Every ounce of silver that leaves a Western vault and goes to a strong hand in the East is an ounce that is likely never coming back. The drain on physical inventories is reaching a critical point. At some stage, and it may be sooner than people think, the paper price will be forced to converge with the physical reality. When there's no silver left to deliver at these low prices, the price will have to rise. And not just by a little, but by a lot, to incentivize new production and bring existing holders to the market. The recent bounce from 72 to 85 is encouraging. It shows that there are strong buyers lurking, ready to step in on any significant dip. This is not the price action of a dying bear market. It's the price action of a coiled spring. The key takeaway is to focus on the big picture, not the day-to-day noise. The big picture is one of a historic transfer of wealth and power from west to east. It's a story of a critical metal facing a massive supply crunch, and it's a story of a deeply undervalued asset on the cusp of a major repricing. Don't let the short-term volatility scare you away from the long-term opportunity. The smash to 72 was a test. It was a gift for those who understood the fundamentals. Those who sold in a panic will likely regret it. Those who held on, or even added to their positions, will likely be rewarded. The battle for silver is far from over. In fact, the declaration of silver as a strategic mineral has just raised the stakes. We are moving into the endgame for the paper-silver market. The divergence between the paper price and the physical reality cannot last forever. One of them has to give. And with the physical inventories disappearing, it's the paper price that is living on borrowed time. So, as you watch the price swings in the coming weeks and months, remember these three pillars: the east-west price split, the physical drain from the vaults, and silver's new status as a strategic government asset. These are the fundamentals that will ultimately drive the price. They point to a future where silver is valued not in the tens, but in the hundreds. This isn't just about making money. It's about preserving wealth during a time of great monetary change. It's about owning a real tangible asset in a world drowning in paper and debt. The silver market just sent us a clear message. The shakeout was intense, but the foundation is stronger than ever. The bull market is not over. It's just getting started. Thanks for watching. If you found this analysis valuable, make sure to like, subscribe, and hit that notification bell so you don't miss our next update. Stay strong and keep stacking.